Good morning, everyone, and welcome to CRI's webinar on CECL fundamentals. My name is Jimmy Woodall. I am your facilitator today, and joining me is your presenter, Doug Mims. We'll talk a little bit about us here in just a second, but we want to make sure that everybody's here and excited to go this morning about our CECL webinar. We've put together some great material, and I say we, and I mean Doug has put together some great material talking about the new credit loss model that the FASB has issued the standard on and will start going into effect later this year. So let's talk a little bit about some housekeeping items and our presenters as we go forward. All right, you can see here our bio for Doug Mims. Again, he is our senior banking partner here in the firm. He's in Atlanta, and he's the ultimate Atlanta sports fan. I know he's excited. We got the Braves are up 6 games, I think, 6 or 7 games in the East, heading into second week of August. So that's a good sign. And I know we got college football starting here in a few weeks, and I know he's always excited about that. So he's just an all-around Atlanta sports fan, and I know he gets into this stuff a lot. Move on. Absolutely. All right, you can move over to mine. Next one. And I can't believe that that's the best picture that our marketing folks can put together there for me, but we might have to check on that one. But that's me. I'm Jimmy. I'm the firm's assurance service line leader, and I work into all the processes where Doug is the technical guy into a lot of our financial institutions literature and the work that we do there and serves those clients. I'm kind of the overall process guy. So, all right, let's talk a little bit about some other housekeeping items. All right, so CPE, very, very important point we want to make sure we address. You'll get 1 hour of CPE credit for attending this. It's an A&A category of CPE. We do ask and do require, NASBA requires that you attend for the full 50 minutes of this session. We've got a lot of material to cover in 50 minutes, so I'm trying to speed through the housekeeping items, but you have to attend for 50 full minutes. And we're also going to have 7 poll questions, and we need you to participate in those poll questions. We need you to answer those poll questions in order to be able to grant you CPE credit for that. All right, you'll get certificates. Those will be delivered within 24 hours. You can see the email certificate the email address where those certificates will come from there. And you can address any questions that you've got about that certification process for CPE to our marketing department at marketing@cricpa.com. A couple of other things. Again, here we want this webinar to be as interactive as possible. I know we're going to throw a lot of information at you as we go through this. But on the right-hand side of your screen on your control panel down toward the bottom, you should see a little section there for questions. As you got questions about the material as Doug's presenting that, please type those questions in, and we'll try to get those relayed to Doug to make sure we can answer those and get everybody's information out to them, questions answered and so forth as we're going through. Again, we want it to be interactive. Ask you to do that. We'll mention this later in the webinar as well, again, but we've got a follow-up webinar to this that's be more specifically related to financial institutions in CECL. That'll be on October 17th. So go ahead and save the date for that. Put that on your calendar. This information is going to be more general as CECL relates to pretty much all entities, but there'll be one more specific to financial institutions a little bit later. All right, that should take care of the housekeeping items. I'll go ahead and turn it over to Doug.
Okay, thank you, Jimmy. Well, thank you everybody for joining us this morning for a CECL overview. As Jimmy mentioned, this is kind of industry neutral, if you will. Or at least that's the intent. It's hard to talk about CECL and not talk about banks and credit unions, but anybody who lends money, anybody who has credit facilities they offer customers, it'll apply to, and also anybody who has debt securities, it applies to relative to the credit exposure for a debt security. So. We'll keep it high level today. We'll dip down a little bit, but again, we have a follow-up webinar on tap that we'll try to get a little bit more specific about implementation. But in the meantime, today what we're going to cover is we're going to talk about who's affected and when. We're going to talk about from a high level what's changing. We're going to go through the top 10 truths of CECL. I have to disclose that those really come directly from the FASB. I attended a course where a fellow from the SEC came, who happened to be male, a fellow from the SEC, came and gave a presentation on CECL, and it's very similar to this one, in particular the top 10 truths, and that's kind of, FASB actually uses those. So you'll be getting it straight from FASB on almost a real-time basis, because that was only about 30 or 45 days ago. We'll talk about purchase credit deteriorated assets. We'll talk about available for sale debt securities. We'll talk generally about disclosures, recent updates, CECL readiness, and then we'll refer to some direct you to some resources, and then we'll take questions, and we'll seek to manage our time wisely here. So effective dates and summary, just a little bit of background. You probably all know this. So the exposure draft for CECL came out in, the first one was in 2010. A follow-up exposure draft came out in 2012. That's the exposure draft that ultimately was approved and was passed by FASB in 2016. So it took 6 years to get it approved and settled. And now we're in a window where we're looking at implementation dates, and as you all know, and I'll explain a little further in just a second, those continue to move. So if you're a private company and you're looking at complying in Q1 of 2023, if and when that happens, it will have taken 13 years for this to happen, which is I don't know, somewhat insane to me. But at any rate, so if you're an SEC filer, and as it stands right now, if you're an SEC filer, you have to comply the first quarter of 2020. If you're a public business entity that's a non-SEC filer, it would be Q1 21. Non-public business entities would be, and that's most of the people I'm assuming on this call. That's most banks and credit unions. That's most finance companies. Other non-bank lenders would be Q1 21. But what's happened since this time is there's been additional changes in the dates, and so there's a pending proposal, which everybody knows by now, so SEC filers that are accelerated filers, and let's just say the larger SEC entities, SEC filers, they still have to comply Q1 2020, absent something literally coming from Congress between now and then. And then for everybody else, there's no more staggering, there's no more differentiation between PBEs, non-PBEs, etc. Everybody else has to comply everybody else with a calendar year end has to comply Q1 of 23. So in the last 6 months, it has been delayed further 2 years, and so that's where we sit today, and that's the world that we live in now. Obviously, 2023 seems like a long time away, and a lot of things can happen. But as we found out from before, since passage, to get to where we are, it really isn't that far away, and so it's never too early to be thinking about it and talking about it. The other area is that I did want to mention is vintage disclosures. They're initially required for SEC filers. That is still the case, and then they will apply in 2023 to everybody else. So that requirement will change as well. And there may be a staggering even of that. I haven't seen that. So, and that's the lesser of the issues at this point. If you're an SEC filer and you're tuning in today, if you're a large SEC filer, obviously you have a problem because you're not going to make it in Q1 20. I'm assuming that everybody on this call is not that, and that you all have a longer window. And so really disclosure is probably the lesser of the issues that we all need to be tackling right now, although it needs to be in consideration, and we'll talk about why through the process. Okay, so what's changing? Under loans, there's held for investment, which means a typical loan that's on your books. CECL applies to a typical loan, which you all probably know. Loans held for sale, there's no significant change. You may or may not have known that. Debt securities, HTM securities will change under CECL. AFS and the credit loss model will change under CECL. And for trading securities, there'll be no substantive change. As for my asterisk, the allowance for purchased financial assets with credit deterioration determined in similar manner. However, initial allowance added to purchase price. So this just purchased loans that are purchased impaired, which would be today would be our purchase credit impaired loans. They do change under the standard. I won't go into that now because I have a slide later, but the old PCI, the old purchase credit impaired loans will be superseded. The accounting for those will be superseded under CECL. Also, under the new credit loss model, credit losses on AFS securities will be recorded through an allowance. As you know today, if there is a other than temporary impairment and a loss is recognized, that loss goes through the P&L. It goes through your income statement. And under the new guidance, it will go through an allowance. And I'll talk a little bit more about that later as well. And I already have a poll question.
All right, we'll launch our first poll question here. Okay. Under the current FASB proposal, topic 326 will be effective for non-SEC filers for periods beginning after December 15th, 2023. Is that true or false? We'll give everybody a second to answer that.
This is one of your poll questions, Jimmy. They need to read it close.
Are you trying to imply that I have tricky questions?
Trying to imply that I miss a lot of your questions, and it's not because I'm not listening.
All right, we'll go ahead and close the poll. Looks like we've just got just about everybody in. We'll share the results here. All right, 61% said true, 39% said false.
So it's applicable beginning 1/1 for calendar year ends. It's applicable beginning 1/1/23. So technically, it's applicable for periods beginning after December 15, 2022, under the current proposal. Not after December 15, 2023. You understand that, Jimmy?
That is a little tricky, but yes.
But it would still be applicable if it was applicable in 12. Yeah, so maybe that's a bad poll question. I'll change that poll question. Okay. Top 10 truths of CECL. The first item is there will be an allowance for credit losses. Now, some of this is pretty basic, but now under CECL, when it's implemented, when it's Q1 of 23 under the current proposal, there will be an allowance for credit losses. It will no longer be called the allowance for loan and lease losses. It is an allowance for credit losses, and it will in fact be an allowance. So there will be a valuation account just like there is today. It will be deducted from the amortized cost basis of financial assets. It will be used to present the net amount expected to be collected from day one, and the changes to that allowance will flow through net income. Now that's pretty basic, and probably everybody already knew that, but we are going to a little bit of a change not methodology, but in how we describe it. It will be allowance for credit losses. And for non-bank lenders, it really already is that. So that's kind of for banks and credit unions. So graphically, what does that mean? So you have the amortized cost for the unpaid principal balance lent to a customer. You adjust it for loan fees and origination expenses, the old FAS 91, ASC 310, repayments, write-offs, non-accrual practices, and certain hedging transactions. So that's your unpaid principal balance net of the things that it's net of today. And the C is the remaining amounts expected to be collected. B is your difference, is the allowance. So theoretically, you take essentially the net balance on your books, you determine what you think you're going to collect, that's C, and the difference between those two is your allowance. theoretically, you're looking at what am I actually going to collect, which is really kind of different than we think about it today. The second truth under CECL is expected credit losses shall be measured. It's going to say shall be and can be and whatnot, but they shall be measured on a collective pool basis if the following two things are in place. The asset has similar risk characteristics with other financial assets, and the risk characteristics, those can include credit score rating, asset or collateral type, size, effective interest rate, term, geographic location, borrower industry, vintage meaning year of origination, historical or expected loss patterns, could be your risk rating, right? Doubtful, substandard, whatever. Reasonable and supportable forecast period. So if you can actually group them by the reasonable and supportable forecast period. Here's what I'd say. Most people now group their loans in based on common risk characteristics. So for a financial institution, normally that's going to be by call code. Now you don't have to do it by call code. I think the thing about CECL that really is it actually is good at the end of the day, but it also is challenging, is that the guidance is open-ended. They don't mandate that you pool a certain way. They say you do pool if you have assets with common characteristics. In theory, if none of your assets, none of your loans had common characteristics, you would evaluate them. Every single one of them would have a separate reserve, which obviously that's not practical or logical. But so it's saying, hey, group them the way you manage credit risk is what it's saying. And most of our clients and most of the people I've worked with over the years would group that based on call code, because that's kind of how they've thought about it in the past. But you don't have to, and you can see some of the other ways that you can group. So, and that's one of the first things you need to do is when you're looking at CECL and actually looking at potential implementation, et cetera, and evaluating things is, how do I really manage my portfolio? Because with CECL, it's a different thought process when on day one you have to estimate not really what your losses are going to be, but what am I actually going to collect on day one? The timing of recognition is different. And you might, in certain instances, decide that you don't want to group them the way that you do today, that you want to group them differently because you want to more closely align with how you actually manage credit risk, not just the way that you report in your call report to the regulators. Now, obviously, as I said earlier, it's hard to talk about this without talking about banks and credit unions, but our non-bank lending clients group theirs similarly. They group them by type. Most people don't group them by some of these other things such as geography, borrower industry, vintage, that kind of thing. But you can. So it does provide latitude. So if here's the scenarios in which you can evaluate on an individual basis. If you have an asset that does not have similar risk characteristics with other financial assets, and an example is a loan in default or a receivable past a delinquency period. Now, that could be a TDR. I think it could be a loan that's greater than 120 days. I think there's a variety of reasons why a loan might be an outlier. So if you have a loan that's an outlier from the rest of your portfolio, you do have the ability to evaluate it and establish the reserve for it separately than the pool process. But that's one of the things that you need to think about early on is how you're going to group your loans. The third truth under CECL, expected credit loss may be determined using. So again, I do want to point out, and I underlined it for a purpose, obviously, maybe. So this is not a requirement. So you can use various methods, including the discounted cash flow method, loss rate, roll rate, probability of default, provision matrix. And those aren't all the ones. Those are the ones that are mentioned, I think, explicitly in some of the examples in the standard. I think there was a discussion initially where people were asking, hey, do you have to use a discounted cash flow methodology? And there was some concern that that's the only way you could do it. And so the FASB is trying to make sure they communicate that, no, you don't have to use any particular method. And the other thing is you don't have to use any one method for your portfolio. So if you have a pool of loans that you think would better represent the amount you expect to be collected by using a roll rate, that's what you should do. If you have one that you think would a pool that would better be represented by a probability of default, that's what you need to do. If you have an individual loan that doesn't have common risk characteristics, you can use one of these methods. So as I mentioned before about how you group, how you segment, the standard, as you read it, the standard is open-ended. The standard does not dictate what you have to do. It says use the method that you think is most cost effective in realizing the most appropriate result for your institution or your company. So open-ended. So and the reiteration here is you're not required to utilize probability weighted discounted cash flow model. Now similarly, and I'll go ahead and mention this, so there's been a lot of discussion in the banking space and in the credit union space about the WARM method, that the weighted average remaining maturity method. There's a couple of things. Number one, the FASB put out a Q&A on it and said, hey, yeah, we think WARM works. Then subsequent to that, there's been a couple of webinars that have been put on by the joint regulatory bodies, and they have addressed WARM. They did a follow-up webinar where they focused solely on the WARM method. And because of the number of questions that resulted from that one, then they indicated verbally in a roundtable that I was in May that they were going to do another one on WARM, more of a Q&A format. So I would say this: if you're a bank or credit union, do you have to use WARM? No. Are the regulators formally endorsing it? No. Is FASB formally endorsing it? No. But certainly they are making it clear that it is a method that they see favorably, or else they would not be investing the time and resource to continue to go over it. So WARM is a method. It's one that there's a lot of guidance about. For a lot of community banks, it might make sense to use WARM, but it is not required. And it is not required for non-banking institutions who lend money either. Okay. Truth number 4. I'm not sure if I'm moving fast or slow, but I'm moving. Expected credit losses shall be measured over. So this is the period of time. So when you're on day one, when you're looking ahead, what's the period of time? The contractual term, considering estimated prepayments. So you do look at the contractual. This is a common question. People have asked this question. I've seen it. I've seen it in live sessions. I've seen it in webinars. They're saying, well, what do you look at? Well, the answer is you look at the contractual term of the note, but in all instances, you need to consider estimated prepayments. There's no scenario where you don't consider estimated prepayments. So even if you feed your information, if you do a real simple analysis, if you will, I say real simple, a more simplistic analysis, let's say you're using WARM and you've got a tool and you feed it in there from your call codes and everything, and it populates and you got your historical losses, and it looks a whole lot like what you do now for your historical loss pool, because it would. You still have to estimate prepayments on the same basis that you pool. So no matter what you do, if you pool based on maturity date, vintage, common risk characteristics, whatever you do, you still have to estimate prepayments. So that is a key component. There's no scenario where a entity is going to be able to drop their numbers into a model and let it push out a result and not have to intervene and address assumptions. So, and that I stress that because that's been stressed in a lot of the things that I have attended. The contractual term shall not be extended for expected extensions and renewals or expected modifications unless a TDR is anticipated. So it does contemplate a TDR, but otherwise you wouldn't extend the contractual term even if it's a note. So if you've got a note, a line of credit that renews, and it typically it's I don't know, say it's a year or two or whatever, and you know that most likely, unless something adverse happens, that's just if something gets renewed and it's a long time customer, and you know you're going to do it. Well, the guidance says no, you can't do that. You've got to base it on the contractual term, considering estimated prepayments. So I'm sure there'll be exceptions as we go through this. There'll be interpretations. There'll be further guidance on some of these things, particularly in the Q for banks and credit unions, and particularly in the Q&A. But that's baseline. That's what you're supposed to do. I will point out one thing, and I know this is probably not something you want to do, but it's the ASU 2016-13 is topic 326. So if you look down in the bottom left of most of these slides, the actual reference to the authoritative guidance is down there if you want to go take a look at it. So if you want to go maybe get more color, if you will, or more context, if you will, for what I'm saying, in this instance, you could go to 326-20-30-3, paragraph 3 through paragraph 6, and you could actually read it for yourself and interpret it as well. Item 5, and we have a shall consider available information relevant to assessing collectability. So your company shall consider all available information relevant to assessing collectability. And it talks about this information includes internal, external, or a combination thereof. And I think that's another open-ended area, good or bad, is saying, hey, you can, for past events, current conditions, and reasonable and supportable forecast, you can use internal sources, you can use external sourcing, or you can use a combination. But you don't have to use any one of them. It's open-ended, and so that's an important point. This is probably a good interval. I might be getting ahead of myself a little bit, but under the standard, past events, current conditions, reasonable and supportable forecasts. Okay, this is probably what I should have said on slide 1. Today, if you're a lending institution, past events, what is that? Past events is your loss history. We have that today. We use that today. Now, if it's not any good for some reason, or you restructured your organization, or you've got new management, new ownership, there's a reason why that's not the best information, then you wouldn't use it today. Well, you wouldn't use it under CECL either. But past events is your historical losses. Current conditions. Well, what are current conditions? Current conditions in today's environment are qualitative adjustments to historical information. Sounds pretty familiar, particularly if you're a bank or credit union. It should if you're any kind of entity, because you have historical losses, just straight math, right? And then you've got the current environment. Well, that's your qualitative factors today. What I'm saying is that if you're sitting here and you're a community bank or a credit union and you're going, okay, well, this is totally different. No, it's actually not, because you pull your loans today for your ASC 450 bucket, you pull them. And in theory, you pull them based on common characteristics. And when you pull them, you apply the historical loss percentage to them. And you should be considering qualitative factors that you adjust that historical loss factor for. That could be up or down, by the way. Most people, it's only up, but it could be up or down. That's in today's world, we consider, if we're following GAAP and the supplemental information that's out there, we are reserving for past events and current conditions. The part of this that's new is the reasonable and supportable forecast, but it's only one of the 3 pieces. It's not the entire methodology. So additionally, you're not required to search for all possible information that's not reasonably available, and you may find that internal information is sufficient. So And this is discussed in 326-2030-7 and 8 if you want to go take a look at it. So that's truth number 5. Truth number 6, historical credit loss information. So that's the past events part I was just referring to. Generally provides a basis for assessing expected credit losses. It says, shall consider adjustments for differences in current asset-specific risk characteristics within a pool, contractual term, and different economic conditions. What it's saying is that if your historical losses need to be adjusted if they don't represent the risk in the pool to which you're applying, or the individual credit to which you're applying. So they can be adjusted, which is really a little bit redundant with, well, probably directly redundant with what I just said. So that's consistent with what we're doing today. 6, any approach to assessing collectability is subjective. Similar to some of the other things that we've talked about there not being a mandate to do it this way or to consider this explicitly, here's some things to think about. Entities manage credit risk differently, therefore various methods are permitted. Varying methods may result from differing degrees of portfolio complexity and sophistication. That was what I was mentioning earlier, where you might apply a different loss methodology to a different pool, depending on what you think yields the most appropriate result of the amount you expect to collect. Not the amount you expect to lose, the amount you expect to collect. In a range of acceptable outcomes, only one acceptable choice would be rare. Again, leaving it open-ended. You should not default to using only the most observable external data if internal market data is more relevant. So the inference there is use the best information, and that's consistent with prior slides, but it doesn't matter if it's internal or external. Use the best information. Is it reliable, and does it represent the associated risk that you're seeking to capture? Use the best information. The most subjective, and this is a reference to what is the most subjective aspect to this process, and that's the qualitative adjustments to the historical. And the board expects adjustments, the FASB board expects adjustments to current and future. So that we're doing that today. Qualitative adjustments to historical losses happen today. They happen in banks, they happen in credit unions, they happen in finance companies, they happen in other non-bank specialty lenders, or they should be. So that is nothing new. Will the bar be higher potentially? Will your financial statement auditors expect you to document it with more clarity and specificity? Possibly. Might your regulators, if you are a regulated entity, expect you to more clearly embrace the authoritative guidance as a result of CECL than they do today? Yeah, that's possible. But the general idea that we adjust quantitative data with qualitative adjustments, we do that every day today. Truth number 7. For periods where forecasts are not supportable. So remember, reasonable and supportable forecasts. Reasonable and supportable. So in situations where that information is not reliable, the entity shall revert to historical credit loss information. It should be reflective of the contractual term. Again, there's multiple references to the contractual term. Immediately on a straight line basis or using another rational and systematic basis. Shall not adjust for existing and expected future economic conditions. Reversion can be complex and it can be confusing. I've looked at some different things that have, some of which have confused me, but the general concept is not confusing. That is, if you look at all the sources of data that you have available to you, and this doesn't mean for the whole allowance for credit losses necessarily. It could be for a particular segment, because you're going to make those adjustments based on how you pool or how you evaluate your portfolio. You could have a scenario where you do not feel that anything beyond today is that you can't get the data to address that third piece, that reasonable and supportable piece. In the event you can't, then you are allowed to revert back to historical loss data, and you can do it on a straight line basis. So, and they call it the reversion period. So there's some examples that get kind of confusing. There's a white paper out on the ABA site related to reversion that you can take a look at if you like. I didn't mention that earlier, and I'll talk about that towards the end about what the resources are out there. But so just know that if there's a reason that the available information, be it internal, external, or other, that you don't feel like you could rely on it for a particular pool or particular loan, then you can revert to historical data. I think that the risk is that folks will automatically revert to historical data, and I don't think that's acceptable under the standard. I think it's only after you have documented and shown that, in fact, there's a reason you can't go out. But the reasonable and supportable period is expected to be short. If you come up with 10 years, nobody thinks, you know, the periods I've seen are 18 to 24 months for smaller entities. I mean, most of our community banks or finance companies or credit unions don't have economists on staff. So, I mean, you got to do something that's reasonable. So normally, 12 to 24 month window is going to be your reasonable and supportable period. But just know that in those instances, reversion, as you get more exposure to this, you're going to hear about the reversion period, and you're going to hear about reverting, and it's talking about reverting to historical credit losses. And the good news is you could use the straight line method, which typically is the easiest thing to do. This reference indicates you're not expected to use the reversion technique if you're able to forecast over the estimated life. So that's really what I was saying is don't automatically revert. Only revert if you can't make the estimation. So the reasoning is the reversion is needed to meet the measurement objective under the standard, which is the amount and the amount the entity expects to collect. I think that's a typo. I don't think it's amount and entity. I think it's amount the entity expects to collect. It's not decision useful to ignore certain time periods merely because an entity is unable to precisely estimate. So that's the rationale for the reversion period. And we do have a poll question coming up, I promise. Jimmy's waiting for it, but it's after 10, after item 10, and it'll pick up from there. Okay, number 8, expected credit losses shall be measured even if remote. So even if you think that it is remote, that you will have losses, you still have to seek to measure those losses. In fact, the whole what would be the old FAS 5 ASC 450 is really not part of this standard. This standard is about what you expect to collect on a forward-looking basis from day one. So here's what the standard says. However, you're not required to measure when expectation that payment is zero. Expectations can't be solely based on the current value of the collateral. I'll talk about, the old impaired loan concept is gone under this standard. There is no the likelihood, is it probable that I will receive all the dollars due me under this contractual agreement in accordance with it in a timely manner? And if the answer is no, well, you're definitionally impaired. Now let's look at the underlying value of collateral. That goes away. That is not part of this standard. So impaired loans as we know them today will be gone under CECL. The board did not explicitly state specified financial assets where non-payment is zero. I won't cover that. It's a little bit confusing. In fact, number 8 is a little bit confusing in general. I do think it's important to note that you do have to estimate what you expect to collect, even if you think it's remote that you're going to collect everything, unless you determine it is in fact zero, at which time I would assume it'd be a charge-off. Number 9, expected credit losses for off-balance sheet credit exposures shall be measured. Okay, so you're expected to measure credit losses for off-balance sheet credit exposures. They are supposed to be part of your methodology, which is not necessarily what we're doing today. I think in some instances we are, in some instances we're not. It's clearly and directly identified in 326.20.30.11 of the standard. Over the period that the entity is exposed to credit risk via present contractual obligation unless unconditionally canceled by issuer in which no credit loss is reported. Okay, so you've got to estimate what you expect to collect and thereby what you won't collect on things that are off balance sheet, unless there is it can be unconditionally canceled by the issuer. So unconditionally canceled by the issuer, not the borrower. That's an important point, and I stress that. If you can cancel it, then it changes the dynamic. But just because the line of credit can be canceled by the borrower, that doesn't change it. When measuring credit, consider both the likelihood of funding that will occur and the amount expected to be funded over the estimated life of the commitment, again, the contractual term. So you should estimate for a off-balance sheet item that may not be funded today. You should consider the likelihood that you'll fund it, the amount and timing of that funding, and then you should determine the likelihood of collecting the amounts owed under that. And if that amount is different than the contractual amount, then you would recognize an allowance for credit losses. Collateral dependent financial assets, this is what I was speaking to. So if repayment is expected substantially through operation or sale of collateral when borrower is experiencing financial difficulty. This is a little bit, based on what I've seen, this is a little bit oversimplified. Today, as a practical expedient, most folks that particularly banks and credit unions, and we'll say real estate loans is normally where this comes into play. Today, somebody's not paying on time, or there's chinks in the armor, there's reasons you think the loan is not, and you have it adversely rated, and you think it's impaired, and so you go, okay, well, I'm going to look at the value of the collateral because that's how I think I'll get repaid. That's not what this is talking about. The guidance I've seen is more, you really have to be in the process of foreclosure. A loan would have to be more in the doubtful, what I would call the doubtful category today, for you to be able to use the expedient of going to the collateral. You really have to establish that you will not get paid back any other way. And I don't think that's the bar today. I think today, if it meets the definition of impaired under the standard, which goes away, but today, if it met the standard, then we then look at the collateral, and if the collateral is deficient, we set up a reserve. If the collateral looks like we could cover it, then we don't put a reserve on it. And I think that methodology will go away, and there will be much more, it's going to be much more of a troubled borrower and much more imminent that we'll have to actually take the collateral in order to use that. So the practical expedient measure expected losses by comparing the fair value of collateral to amortized cost, which is what I was speaking of. So the rules have changed. I think that we'll get through a Q&A, particularly for banks. I think it mostly relates to banks because we're probably talking more about real estate loans than, say, automobile loans and things of that nature, or other consumer lending. I think we're talking real estate loans primarily. I think we'll get more guidance and more clarity on that as we move along via the FFIEC guidance and via the Q&A. I think that the Q&A has been updated. It was updated a couple of months ago. I think we'll continue to get updates to that Q&A as we move along the CECL path. And now we have two poll questions back to back.
Actually, we're going to have 3 poll questions back to back.
Okay, there we go. I was working hard.
And we're going to go back and try to pick up a lot of the stuff that Doug has covered already. So, all right, we're going to launch our first one. That says credit losses will not be recorded through an allowance under topic 326. Is that true or false? Give everybody a second here to answer that one. All right. Close it, share the results of that one. 74% say false, 26% say true. And Doug, the answer is?
False.
The answer is false. All right, let's get to our
The
next
not.
question.
The not is what made it false. It will be recorded through an allowance, and it will be called the allowance for credit losses.
All right. Our next question. Expected credit losses may be determined using various methods. True or false? It's a softball here, Doug.
Yeah.
All right, we'll go ahead and close that one down. Share the results on that. 100% say true. And the answer, of course, is true.
True. That's right.
All right, we'll go to the last one for this section here. Estimated prepayments must be considered when estimating credit losses under topic 326. True or false? All right, let's close it down. And 92% said true, 8% said false, and the answer is?
True.
True. All right, that's it for the poll questions for now.
Okay. Thanks, Jimmy. Okay, purchase credit deteriorated assets. So what I mentioned previously is that the old PCI, purchase credit impaired concept, was going away. If you recall, under the current methodology, you would, if you did it by the FASB, by the book, you would have a fair value calculation done as part of it when you acquire loans. As part of that, there would be two marks, two adjustments to the valuation. One would be the credit mark, and the other one would be the fair value mark, based on the difference in interest rates. So you'd have a credit mark for the potential losses, if you will, cash flow, and you'd have the credit. So the credit and I'm getting twisted up on that, but you have the credit mark, and then you'd also have the fair value mark, essentially. So what happens now is and one of those is accretable and one is non-accretable. So under the new guidance, PCD assets and it defines what they are: purchase financial assets that have experienced more than insignificant deterioration in credit quality since origination. At acquisition, the amortized cost basis equals the purchase price plus the allowance for credit losses. You're actually going to gross that up with an allowance for credit losses. If you recall, under the current standard, there is no allowance. That credit mark is not an allowance, it's a basis adjustment, and it's a non-accretable basis adjustment. And now we're going back to where we actually do have an allowance on the books for that, and it's not, quote, a direct basis adjustment. Under this method, the credit-related discount, which is not accreted in income, and the non-credit discount is accretable. So that's the fair value piece. The fair value piece is the non-credit piece. It's accretable, and it's accretable today. That's not new. The non-accretable piece, the credit-related piece, is not accretable. It's not accretable today. The difference is how it's treated on the front end. So you're gonna come to the same number in theory that you do today. It's just going to be an allowance instead of a basis adjustment. Available for sale debt securities. So there were targeted improvements made to the existing guidance, which included an allowance approach would be used for recording credit losses. Again, this is a credit loss standard, so it applies to any credit loss of any financial instrument with a credit loss. So would be used for recording credit loss, which would allow any entity to record reversal of losses. Allowance would be limited to the amount that the fair value is below cost. The length of time, this is interesting, the length of time fair value is below cost should not be considered in determining that no credit loss exists. So today, for debt securities, all right, and just in case you hadn't thought it through, a debt security is a debt instrument that's been issued by an entity. That entity, in order for you to get the return, to get your yield, and to get your principal back, as under the contractual arrangement, that entity that issued the debt, the bond, let's say it's a bond, they have to perform. Okay, so to the extent there are credit losses identified related, and it would usually, or I think almost exclusively, relate to the issuer. Let's just say they have financial problems and the bond is downgraded, significantly from a double A to a, whatever, and it's significantly downgraded, so that it appears that the likelihood is you're not going to collect everything that you're supposed to under the arrangement, then you would recognize a credit loss. That's not different than today, other than the OTTI concept today builds in some other things, and it's saying, hey, it doesn't matter how long you've been in this position. If you've got a credit loss, you got to take the credit loss today. It doesn't matter if it's a month old. It doesn't have 6 months, 12 months, any of these other benchmarks we've been using. Forget that. The day you have a credit loss, you need to recognize it, but you don't have to recognize it through the P&L. You can recognize it in an allowance. Poll questions.
All right, just one this time. All right, purchase credit deteriorated assets will not result in an allowance under topic 326. True or false? All right, looks like just about everybody's answered. And 21% said true, 79% said false. And our answer is
false.
False. All right.
Onward. Disclosures. I don't have any example disclosures. The good news about disclosures is we're going to get to see in the first quarter, assuming nothing changes, in the first quarter of 20, we're going to see what the larger institutions that are the publicly traded folks do. And we'll be able to see, we'll be able to get some formats. I think the formatting and structure, the consistency of that, we got plenty of time for that to evolve, and I think it will. So I think that community banks, credit unions, other non-bank lenders, and whatnot will be able to, and providers like us will be able to help identify what this needs to actually look like. But I think what does need to be considered now, though, is what data are you going to need to comply with the standard? Maybe not what format are you going to put it in, but what data. So let's just go through these as we start tracking down to running out of time. I'll go through these fairly quickly. Objective, enable users to understand. This is the objective of the disclosure. The credit risk inherent in the portfolio, how management monitors the credit quality of the portfolio, management's initial and updated estimates of expected credit losses. Now, I think we kind of do that now, but to meet that objective, but let's go on. The description of the actual estimate. Factors that influence the current estimate of CECL, including a discussion of the risk characteristic changes that influence management's decisions that were not considered in the previous period. Changes in loss severity, portfolio composition, volume assets, etc. We don't do that today. Public companies may do that in their MD&A. That may be part of that discussion, but that's not a required part of the notes to the financial statements. And it's also, not only is it not required, it's not being done in practice for private companies. So that would be a new thing. The reason for significant change in the amount of write-offs. Again, the management discussion and analysis portion of a public company probably would address that if somebody had significant write-offs. We're not doing that today in our private companies, and we're not doing it in the note disclosures for our public companies. The amount of significant purchases and sales of debt instruments during each period. I think that's already we're doing that. Amount of any significant sale or reclassifications to held for sale assets during each period. We're doing that now. For collateral dependent assets, qualitative discussion of the type of collateral, extent to which collateral secures financial assets, and any changes that impacted how much collateral secures the asset. We're not doing that today. So that would be new. Quantitative disclosures. Disaggregation of loan to value, risk rating, geography, etc. by vintage. So this is the vintage disclosures that right now as we sit would be applicable to publicly traded companies initially and would not be for privately held companies. I don't think the vintage disclosures are required. So I'll go through these quick. So they don't have to go, they need not exceed more than 5 annual reporting periods prior to the 5th annual reporting period shown in the aggregate. Reconciliation between this is for PCD assets. So there should be, if you have purchase credit deteriorated assets, there should be a reconciliation between the purchase price and the par value of the PCD assets. That's the part I didn't talk about. You know, you value them, and there'll be an allowance. There's a credit mark, and then there's the fair value mark. But then there's also what did you pay for it, and that could go either way. It could be more or less than the fair value, which is gives rise to goodwill, etc. And there should be a roll forward of the allowance for credit losses. So the only difference there, of course, is that now it's a roll forward of the allowance for loan losses. It'll be the allowance for credit losses going forward. Policy disclosures. Policy for charging off uncollectible debt instruments. Changes to accounting policies or methodology from the prior period. Policy for accounting for non-accrual financial assets. I would say to a large degree we do that, with exception of maybe changes to the accounting policy. But normally we don't have a lot of changes, so it's not applicable. But we do disclose our policy and methodology today for our institutions. Poll question.
Poll question. All right. Only quantitative disclosures will be required under topic 326. True or false? All right, looks like just about everybody's in on that one. Share the results real quick. 83% said false, 17% said true. Answer is false.
False.
All right. That one. Okay.
Okay. So recent updates. So since the initial issuance, Accounting Standards Update 2018-19 was issued. It was a codification and cleanup to topic 326. The next one that was issued was 2019-04. It related to it cleaned up some stuff primarily on for topic 326, but also topic 815 for derivatives and hedging, and topic 825 for financial instruments. And then the most recent one is 2019-05, where that was actually where the most recent delay came from. The most recent approved delay. So that's what pushed it out for most of the folks on this call. It pushed it out to 2022. But the FASB proposal that is out for comment now to be approved for 2023, and the changes there too. And the biggest piece of that, of course, is the small issuers who are going to have to comply 1/1/20 for them. That hadn't been approved yet, so it's not in this list. But it will, everybody assumes it will be approved. Okay, so that's an overview of the standard, and that's according to FASB, that's the top 10 things that they're hearing from folks about and trying to clarify. The next section here is about CECL readiness, and so I'm going to go through this. We're kind of short on time. It's 11:59. We're wrapping up. I'll go through this very quickly by just top level slide. So from a CECL readiness standpoint, I think that if you haven't already done it, I think you really need to make sure that you've educated that your folks are up to speed, that they know what CECL is and what it's going to take. I think you need to make sure you're educating your board. I think that you need to determine who's going to tackle it. I don't think even in the smallest of institutions, it probably doesn't need to rest with one person, because it could change the way you lend and the way that you manage credit risk. Sometimes, is typically with your chief credit officer or whoever wears that hat if they don't have that official title. I guess the best practice that we would recommend is typically that you would include folks from all the primary disciplines within the institution that will be affected, because it's not just an accounting thing. It certainly might be your CFO, but it certainly is a lending person, and it might even impact the person who handles your investment portfolio, which also might be your CFO. But also evaluating training needs and assessing internal and external resources. Next, kind of along the continuum and is risk identification and segmentation. We've already talked about that, but that's deciding how you're going to group your portfolio. How do you manage credit risk? Where can you get the data from? Where are your risk drivers? How should you pull? So we kind of talked about that, and that's what this slide's about. And I'm going to refer you to somewhere you can actually pull this information down, and you're going to get the slides. Data inventory and gap analysis. Once you decided, who are the players, how are we going to group them? You need to determine, do we have the data? And then if we have the data, how can we ensure it's accurate and complete? And then do you have any gaps? So again, what we said earlier, there's a wide array of places you can pull data from and use to develop the estimate. It doesn't have to be internal. It doesn't have to be external. It can be a combination thereof. And you need to be thinking about, what data am I going to need? Because you can't wait. If you wait till 2022, really what you want to do is be in a position to be running your models, your current model, against this parallel no later than 2022. And so that you'll be able to work out any kinks and you'll be ready to push go for Q1 23. Because if you're a financial institution, even if you're not publicly traded, you still gotta have your call report right. Technology and resource assessment. Do you have the in-house resources? Do you have a model? Do you need to talk? Do you need to buy a model? Some of those things that are considerations. I think most folks on this call are probably spreadsheet based now. I don't think it's clear that it's okay to continue to be spreadsheet based. Can you document things that like you need to in your existing model, because that spreadsheet is a model? I think that's a big question. I think that's a question a lot of our clients should be asking themselves. Governance and oversight. I think you need to define the roles of senior management and the board. You need to make sure you have policies and procedures. Anything you have to change that's related to CECL. Do you have to change your loan policy? Do you have to change any of your operational procedures? You've got to build controls and processes around the model that maybe you don't have today. So some of those considerations are out there as well. And with that, the final poll questions.
The last one.
Summary.
Yeah.
One.
Yeah, just the last one. All right. Okay. The warm method estimation has not been endorsed by the FASB as the preferred method under topic 326. True or false? All right, just a second. We got some more coming in here. All right. Share the results on that. 79% say true, 21% say false. Answer is, Doug?
That is true. The warm method has not been endorsed. They've talked about it a heck of a lot, but it has not been endorsed by FASB or the banking or credit union regulators.
Okay.
So from a resource standpoint, I don't think our links are live on this. If you pull these down, I would say the best resources, the FASB has a lot of resources. If you go under their transition resource group, there's three relevant webinars that were included: the Fed, the FDIC, whatever that CSB, that's the state bank, the state banking regulators, their overarching group. FASB and SEC. They've all been on these, which I think is really good because that means we're getting one unified voice. They've done 3 relevant webinars. FASB, just go under there and look under projects, look under CECL. They have 2 Q&As now. There's another Q&A that's come out the same day that they proposed the delay, talking about CECL. So there's two Q&As out there from the FASB. Interagency guidance is for banks and credit unions. There's not a new internal interagency guidance on the ALLL. What there is an updated frequently asked questions document that's 40 some odd pages, and the interagency guidance is in the works. Now, they originally said they were going to issue that in July, but I think they knew this delay was coming, so they probably paused. Hopefully we're going to see that, because that'll give us all a lot more clarity if you're a bank or credit union. Other resources would be also the AICPA. They have a credit losses section, and in there it talks about the activities of the depository and lending institution expert panel, and because they've handled 40 or so technical questions, and that's in there if you want to read that stuff. So those are some of the resources. Ones that aren't listed here would include there's a CECL section on the American Bankers Association site that I found useful as well. There's actually some slides if you want to do some board training and some other things.
All right, with that, we've not gotten any questions put in to be asked, but if you've got any, you want to go ahead and take your time now and type those questions in. While we're doing that, Doug has gone to the next slide. You can see there are information in terms of today's presenters. Again, you can see Doug's information there. You can reach out to us if you've got any questions. Also, CRI is available on social media, Facebook, Twitter, LinkedIn, so forth. You can look at us there. We will remind everybody, I think we've got another slide here, but if we don't, I think we do. But yeah, here it is. We've got some upcoming webinars. Again, we mentioned this earlier at the start of the webinar today, but we want to remind everybody there will be something that's more focused on CECL as it applies to financial institutions. That'll be October 17th. Please mark your date for that. And then you can see a couple of other ones that we've got coming up that, might be of interest to you. Certainly take advantage of those and mark your calendar for those as well. If we don't have any questions, and it doesn't look like we have any questions coming in, we thank everybody for their time today. Thank you, Doug, for putting this information together and presenting it. Thank you for our marketing folks for helping set it up. And that'll be it. And please let us know if you've got any questions or need further contact from CRI.
Okay, thank you, Jimmy.
Call it a day. Thanks.